Would you qualify this as a sell-off, one in which we might see more than a couple 100-point declines before people start coming in? Is this a game changer?
No, it's funny. Corrections are only considered natural, normal, and healthy until you actually get one. And then once you get one, it's got to feel, by definition, it's got to feel different or nobody would sell it. So the move up in the long end of the curve on the 10-year note yield up to a 284 is obviously creating a little bit of angst ahead of the weekend. And people that had been kind of chasing stocks up, the weak hands, as it said, they're coming out of stocks. But it's really, the market was so extended that it's really not so outside of expectations.
As you've said, a correction feels healthy until you actually get one. But we have been asking the question now for many weeks, why interest rates have remained so low, and coming up with all sorts of excuses about particularly why the back end is so depressed. At what point actually does it become more broadly a problem for the kind of lofty valuations that we've been talking about in equity markets, beyond just a couple of percentage points shift lower perhaps that we're seeing so far?
Well, really, I don't think it's the absolute level. History shows that it's a spread between short-term and long-term interest rates. The only time, for perspective, and I've said this so many times on air, for perspective, the only time you want to become really negative on equities is after you've inverted the yield curve, which means short-term interest rates are higher than long-term interest rates. All this move up in the yield has done is actually made that less likely. So I would make the case that the movement over the course of the last 2 weeks in the long end actually elongates the cycle. It doesn't shorten it. It just makes for a more volatile environment. And there's a great chart that I've used from my Bloomberg terminal, which is the Monetary Policy Uncertainty Index.
Oh, yeah.
And we've gone through a historically low level of monetary policy uncertainty. We're coming into the realities of what a strong economy does when you're coming off historically low interest rates, and that creates volatility. Even if you have further upside, which is our call, you're going to have more volatility getting there.
Yeah, and if you look at in terms of market pricing, I mean, the pricing of the Fed funds rate 2 year out has risen by 100 basis points since September. I mean, Cameron was talking about this to us earlier on. There's been a real sort of reassessment, I think, of Fed pricing here, that we were behind the curve, or at least the curve was behind the Federal Reserve. And I guess that repricing could continue a bit here. The data looks good.
The data looks good, but actually when you look at things like the Citigroup Economic Surprise Index, it's historically high and ticking lower. So actually what you're kind of in is a near-term conundrum where the data is going to be very strong, appearing very strong to the Fed, and it's going to be good data, but it may come in a little bit below lofty expectations. So again, that's the spread between those two things create high expectations, and good data is going to create an arbitrage between short-term and long-term rates that creates that volatility. So we've been kind of looking for a correction, unlike some, maybe the death of me. But when you get real serious drops in the context of such a strong fundamental backdrop, especially for credit, it's not to be sold.
Oh, that's really interesting, Tony. So when are you going to recommend that people get back in?
Well, there's certain indicators we use, like the VIX over 20. Percentage of stocks above the 10-day moving average has to drop a little bit more. So there's certain parameters that happen in the context of a normal correction that's bad enough to say, okay, even if it gets worse, it'll bounce back. When you look at the last time that the investors' intelligence bears were as low as they are now, was 1986. You had four corrections of 5% or more over the course of a 6-month period.